So now I want to move on to real estate. As I said in my presentation this morning, I think it's a massive opportunity. We've barely even scratched a scratch of the surface of this particular industry, and it offers great returns, secure returns, and I'm personally excited about it. So I want to introduce Lewis Feldman, who is a partner at Goodwin Procter, and he is going to run this panel.
I'm delighted to be here with such an amazing group of panelists, people who are pioneers like many of you here, or people who, like me, simply want to be doing something interesting in case they die in the middle of it. Today we have wonderful panelists to talk about real estate. Goodwin Procter is a real estate law firm, as well as a technology firm and a financial services firm. And we've been involved in a number of the ventures that are represented by the people in front of you. And we expect that this is going to be a very, very, very good time for this industry going forward. So we're excited to be part of it. Today we're going to talk about specifically real estate as it is being disintermediated by a variety of platforms. And it's a $13 trillion industry, as we were informed earlier today. And as a result, we know that it has incredible growth and incredible velocity of money and funds ahead of it. So let me quickly introduce our speakers. I know that you have the the panelist bios in front of you. But we have Navith Wall, who's the co-founder and CEO of Realty Shares. We have, this is, by the way, in alphabetical order, no implications as to where each of these people stands on the pyramid of power, simply alphabetical. Christian Fass is with LendInvest, and he's the co-founder. He's a partner at Montello Capital Partners, which is one of the leading short-term mortgage holders in the UK. So we're dealing with the international aspects of real estate and real estate lending. Thanks for being here, Christian. My friend Jillian Hellman is the founder and CEO of Realty Mogul. And RealtyMogul.com is obviously well known as a crowdfunding site. It's a marketplace primarily for accredited investors at this point, using a 506D exemption. And Jillian has a great story and great momentum going for her right now and for her company. Welcome, Jillian. My friend Tom Lockhart. Tom and I have known each other for, gosh, going on 25 years, although in a different industry, the municipal finance industry, where we both practiced. Tom since retired from the muni business and moved over to develop institutional relationships and source new transactions for Fundrise. Bill Skelly, Bill, is a founder and CEO of iFunding, which is the leading online platform for real estate crowdfunding in its space. Mr. Skelly is responsible for business development at iFunding. That's why he put that kind of hyperbole in his bio, and I love it. Seriously, he's responsible for all the business development activities and has done in excess of $2 billion worth of transactions, and we're delighted to have him here. So thank you for joining us as well. So let's go right to the panel questions. I'm going to pose this to each of you, and I'm going to begin with Christian. What size and type of asset does your site focus on? And what would you say is your bread and butter deal?
Sure. So we are a peer-to-peer platform for mortgages in the UK, like Lewis says. In terms of our bread and butter sort of transaction, historically, average deal size is about £500,000 to £600,000. LTVs of about 60 to 65%, so relatively conservative. But the principal thing is it's short-term mortgage lending, so it's bridging, so for 12 months or less in duration. So we're sort of evolving our product, but that is sort of the core of what it is at the moment. In terms of the type of borrower, we sort of define them as property entrepreneurs. So sort of guys, I guess what you refer to in the US as sort of buy and flip type borrowers.
And now I know that there's a big difference between UK crowdsourcing and American crowdfunding and crowdsourcing. Talk about those differences and who are your investors?
Yeah, so I think we're relatively fortunate in the UK with the regulatory environment that we have. So the FCA, or the Financial Conduct Authority in the UK, recently brought in a regulatory regime which was quite favourable to peer-to-peer lenders. For equity crowdfunding, it's a little bit more stringent in terms of the requirements, but for peer-to-peer, it's a little bit less restrictive. So our investors can actually be anyone. They don't have to be accredited. It can be the man on the street putting in £10 per loan. With our platform, we are focused more on the high net worth type borrowers. So we have a £10,000 minimum investment per loan, just because we sort of are trying to get scale, and obviously dealing with mortgages, it's by definition of that larger amounts of money. But in terms of the regulatory regime, we're quite fortunate.
Can I pose the same question to you, Jillian?
Yeah, certainly. So we do both debt and equity in peer-to-peer. On our debt markets, we're focused on residential and commercial. We're doing bridge financing, so it's a 24-month term or less. On our commercial product, we're looking at small balance commercial. It's typically loans between $500,000 and $5 million. On our residential product, it's all single family, largely fix and flip, all short term for right now.
What about some of the marquee type assets that you have on your site? I know that many people know you for like the Hard Rock that's up right now, but you do a lot more debt than pretty much anything else, right?
Right. I mean, we're a debt and an equity marketplace. Lou is alluding to the Hard Rock Hotel in Palm Springs that we're live crowdfunding right now. It's the first hotel in the country to be crowdfunded, and it's an interesting offering because we're able to give investors benefits alongside financial benefits. So free nights at the hotel, discounted benefits as well. But we're
cabanas by the poolside, which is exactly why they wouldn't let me invest. No one wanted to see me in a bathing suit.
It's true.
Thank you.
But we're doing both equity and debt. I think that the really interesting thing for us as we move forward is the ravenous appetite for debt. And I think you can see it in the conference here today and in meetings that we've had. Is there's a lot of interest in real estate debt, both residential debt and commercial debt, and making sure that all of us built origination platforms to manage that appetite.
Thanks. Tom, can I ask you the same question and also maybe give us some flavor of the social influences that have sculpted your company over time here?
Sure, thanks, Lou. So Lou and I know one another because I was an investment banker in municipal finance, and first found the whole notion of crowdfunding while looking at affordable housing loans. And here in San Francisco, I'm from San Francisco, so making hard money loans to affordable housing projects through a nonprofit. And I thought that could be crowdfunded. And it was through that I went and talked with many of the sponsors here today, and ultimately ended up being an investor in one of them, and then actually investing in Fundrise and now working for Fundrise. But the social aspect works both from the point of view of the investor as well as the sponsor. So we're looking at developers who want to create a social network, that want to engage with their investors. And so we're going after sponsors with both debt and equity, but trying to engage the sponsors, which are developers, property developers, into communication with their investors online, the same way we're doing it with our investors. While I've only been there 1 month, I'm familiar, having been an investor there. The organization has done most of its work on the East Coast, in the Mid-Atlantic, and they've been very aggressive about having community presence, especially in evolving areas of Washington, D.C. So there have been community programs that have been involved in engaging investors in what's being developed.
Very responsive.
Thank you.
Anything you're particularly excited about right now?
Absolutely. My niche in the municipal finance world in California, we were a boutique firm. We sold it 3 years ago. We were a boutique firm that did a great deal of the horizontal infrastructure for planned communities in California. And more recently, here in San Francisco, if you've been to Mission Bay or Hunters Point or the Trans Bay that's being developed, we were the financiers for those for the horizontal development, not for the vertical development. But as a consequence of providing that public financing, know the developers who ultimately do the vertical development. So we'll be working with some very high quality sponsors here in California to originate product. At the same time, like many of the other people here, we're looking at the crowdfunding space as really moving towards high net worth people like myself who found Fundrise. Those are the people we're going to be trying to cultivate, and having worked in the municipal industry, which is dominated by investors who are high net worth, I'll be working with that universe of potential investors, which include private equity and hedge funds.
No doubt you will. So let me go to Nav. Talk to me, Goose.
Sure. So at Realty Shares, we do focus on both debt and equity products as well. About 80% of our originations or capital raising efforts are on the debt side. The typical product is a 1 to 4 unit residential building. There's no geographic limitation. We really go where the opportunity is. We look at borrowers that at a minimum have a 650 credit score, but on average our borrowers are around a 700. And they're professional real estate investors like Christian alluded to. So someone who's actually done 5 to 10 deals already and is looking to expand their operations but has limited access to debt capital. So that's on the debt side. On the equity side, it's preferred equity, typically in a more niche asset focus. So it's more multifamily retail. We haven't really broadened the spectrum beyond those two types of assets. We're trying to stay a bit more focused and niche on the preferred equity side. So that's been our bread and butter deals. And we're also now expanding our debt products. So the first 6 to 8 months of being in business, we were doing purely bridge, 12-month or shorter maturities. We are expanding to midterm debt, 3-year maturities, as well as some mezz debt. So a little bit lower in the capital stack, but a much higher interest rate. So risk and return balancing.
What's your average return?
It really ranges. On the debt side, first position loans, we're at about the 8 to 9% annualized yield. That's where we're at on return per year. On the mezz, it's a little bit higher, anywhere from 15 to 20%. And then on the equity, the cash return is anywhere from 8 to 12%. And then an IRR, which includes both the cash flows as well as the profits from sale, in the mid-teens typically.
I just want to point out that Nav, I'm the chairman of the real estate school at UCLA, and Nav's a law school graduate who was #1 in his class at Berkeley, and he's known as being, quote unquote, pretty intense but pretty cool. So, William.
We promote a diversified portfolio at iFunding. We focus on both equity and debt in the residential and commercial space. That being said, I'd say the core of what we do is similar to Jillian, the fix and flip market, which are preferred equity investments that are short term, anywhere between 4 and 6 months. We pay all cash. We don't apply any debt to that specific market. We hold title to it, and it's an added layer of security for our investors. And that's sort of the bread and butter of what we do.
Okay. Let me pose a question to you then. Effective underwriting is often spoken about. Yet people are very concerned that there be standards. It's like buying a drug and having no standards, not knowing really what you're getting. How do you make your underwriting transparent? How is it? How do you do the voodoo that you do so well?
Sure. Well, I think underwriting is paramount to all of us here on the panel. And what we've done is we've taken our collective backgrounds. A lot of us have worked at large financial institutions. We've put together sort of a best-in-class or industry standard underwriting process. That being said, we recently did just engage one of the largest accounting firms to help us identify and write our internal policies and procedures.
Jillian, let me come to you. Security is a big issue. I listened to Leon Panetta last week talk about just how many ways there are to disrupt the American flow of information, which is basically free, as we saw today, but isn't so free when you have none. It's very expensive. I know that I think Panetta said there were over 6 billion ways to attack a site, and you have to be on alert all the time. How do you make sure investors feel safe online, make sure that the guy who's at his terminal or the gal can basically hit that button and know that what's been told to them is true and that it's not going to get out unless they know, including whatever financials or accreditation information they need to provide?
Right. I think there's two levels of security. There's website security, and then there's the actual underlying security, which is the loan or whatever security we're selling. So I'll address both. From website security, we had the brilliant idea to hire hackers. So we have people hack or try to hack into our website. And we actually pay people to try and do this because it is so important to us. And with the proliferation of new platforms, I see other platforms making the mistake a lot. They're not on secure servers. They're not PCI compliant. They're bringing in social security numbers, account numbers, routing numbers. I mean, just gross misunderstanding of security. And that's been paramount to our company since day one. The other thing is security in the real estate. Now, every investment opportunity has risk. I'm not going to sit here and tell you that it doesn't, and deals will go bad, and that's just the nature of it. But we actually think about underwriting very differently, I think, than Will at iFunding. Ours is, how do we build underwriting that is scalable and automated? And that's what we're bringing to the real estate peer-to-peer market that I don't think has ever been done before. And we're using big data. We're using crime reporting. We're using crime blotters. We're using walk score. We're using population scores. All of this massive information that we now have at our fingertips through technology, we're building, to credit algorithms and the ability to scale our originations platform through algorithms when historically you would have to scale them through, best practices from a bunch of different institutions and private equity firms. We think about that very differently. From a security perspective, on our debt market, we have a secured asset. There's actual title for this real estate, which is very different than the lending club and the Prosper unsecured loans. It's a completely different market, but I think that both of those things are very key to what we're all building as a community.
Thanks. Christian, can you talk about your underwriting and how your standards may or may not apply to, is it a global standard now to get people to apply?
Well, I think certainly our processes are different. In terms of the background to our business, we don't sort of see LendInvest as a tech startup business in many respects. So the background is we set up a mortgage lending business in 2008 called Montello. So that's a specialist short-term mortgage lender. And then we sort of incubated LendInvest out of that business. So we sort of see that we've been actively lending in the market for the last 6 years. And certainly we know that our first couple of years were certainly our worst couple of years of lending. And then through that process, we've refined our processes and underwriting criteria, and actually we've got to the point where we're really confident that it's really good. And we see that as the critical role that the platform plays. So we see ourselves as a lending business online. And with the Montello business, we've got a couple of bank funding lines, then they sort of audit our processes and so forth. And the last bank that we got funding from actually said that we do more than what they do in terms of underwriting a borrower. So I think we're very thorough in what we do. Because we're acting in the bridging market, we need to act quite quicker than a bank does. The average mortgage in the UK sort of takes 2 to 3 months before drawdown, where we can provide funding in 2 weeks. But that doesn't mean that we're taking shortcuts in what we do. We're just sort of using technology to sort of have efficiencies and to be able to deliver a service.
Tom, can you talk, I know you've been influencing policy quite a bit in the past when we worked together, working in Sacramento and the federal government as well. What changes do you see need to be made today? We know that there are a lot of shortcomings, but do you have a concise view on what you think needs to be done to make this a more attractive platform?
Not a concise view, but I guess in terms of what I've seen just in the short time I've been there, I'm accustomed to making real estate investments as an accredited investor. And I don't know, maybe many of you out here have done accredited investments, but you check the box indicating that your net worth is sufficient to allow you to invest. And under the Reg D 506C rules, you now need to have a third-party verification. And this is relatively recent. The feedback that I've already seen on this, though, is very fascinating because you've got people who want to invest on the platform coming in, being instructed to provide for that accreditation, and the responses from the CPAs and the attorneys have been fascinating. So I've gotten these flaming emails from people saying, there's no way I'd ever sign off on this. So the regulation is relatively new. It'll be interesting to see how it plays out. But in order to make this robust, we really need to come up with a way that's verifiable.
Or another law firm. Nav, talk to me a little bit about the technological changes that you see coming forward and what you need to scale up.
Sure. So I think one of the reasons we focus so much on debt versus equity is scalability. So each equity deal is very different. You're last in the stack. If you're preferred equity, you're ahead of the common equity, but still, it's very difficult to analyze an apartment building in California versus Texas. So there's a scalability issue there. On the debt markets, it's a little bit easier. There's standard metrics. There's LTVs. There's first position versus second position. There's borrower credit, and I think there's two levels of underwriting that are important, which is kind of different than what we see with Lending Club, Prosper, and the peer-to-peer lending space. You're not dealing with just an individual. You're also dealing with an asset. So you need to underwrite the individual, and then you need to underwrite the asset. You can automate the underwriting of the individual to a certain extent, and you cannot automate the underwriting of the asset to a certain extent. But there's always going to be some human component to it. Not 100% of it can be automated. So to really scale, some of what we're doing will be automated. So the underwriting, checking credit, determining location scores, et cetera. There's enough data out there to automate a portion of that, but we'll never replace our human component, our real life phone conversation, our human underwriting with a purely automated process, because I think that puts at risk the investors putting money into the deal. And also we are in certain functions that we're doing. We're a small team. We understand that we have limitations. So we're working with outsourced underwriting help, audited companies that have originated billions of dollars worth of debt. So we're working with them to establish not only procedures, but also to get some help on the underwriting while keeping a very close look at what they're doing, because at the end of the day, we're putting our name on each deal. So I think that's what we're working towards, and technology will play a large part in that, but I still think there will be a human component to what we're doing.
William, M&A seems to be playing a bigger and bigger part in this business, and we talk about platforms that have advantages that may have scale or have assets or loans that one might acquire. Do you see, are you approached quite a bit? Are you seeing people looking at crowdfunding more and more from a perspective of, buying the business as opposed to getting your service or using you as someone to launch their asset on the web with?
Sure, it's certainly a hot space right now. All of us here on the panel know that. As the CEO and founder of the company, I'm really more focused on execution. I think there will be mergers and acquisitions. At the end of the day, it doesn't keep me up at night. I'm really focused on finding solid opportunities, sponsored by solid operating partners, and delivering capital back to the investors. That's really what I'm focused on, 100%.
Anybody else want to comment on that trend? You've seen people approach you. You can talk about it. You're in London. Nobody's.
Yeah, common questions. We're coming to the US. I think, for us, the UK mortgage market's a huge market. We haven't really scratched the surface in terms of what's achievable. I think, in terms of driving scale is really about, for us, you come to a conference like LendIt, you can see that there's money there. It's really about originating volume, and doing it obviously in a sensible way, so the credit risk and so forth is managed. But for us, it's creating a really cool and awesome user experience from a borrower's perspective. Anyone that's gone for a mortgage knows how frustrating and bureaucratic that process can be. But if through technology we can make it a really smooth and seamless process, then that will be a true winner, and that's how we can drive volume.
Absolutely. So, Tom, liquidity has been a big concern for potential investors who want to get out of a deal. They look at a private equity type transaction where they put money in, or they have a loan and they expect it to flip, whether it's short term or 5 to 7 years like a traditional private equity fund would look at it. how do you make sure, what are the expectations of investors, and how do you make sure that they do have that liquidity event at the end of the day?
Well, it's a huge risk, it seems to me. It'll be fun. I mean, part of the excitement for me, bringing a broker-dealer to what we've been doing is the opportunity for actually creating a secondary market. We're not there yet, but in terms of expectations for liquidity, I don't think an investor comes into it at the stage we're at right now with the notion that there is going to be liquidity, but absolutely, that's what I see. And I mean, the fact that we're fundraised means that we can raise money for all sorts of things. So when you and I were looking at selling bonds on the internet 15 years ago, the muscle wasn't in the system to allow that to be done, and the muscle's there now. So plenty of things can be blown up by this if we can truly provide liquidity in a two-way market on it.
Interesting. Are any of you collecting data from the people who are on your website? And if so, what are you collecting and what do you think is going to be useful?
Absolutely. Everybody who's running a platform is collecting data, whether they admit it or not, and I'm using it to make it useful to the investor. Right? We're using it to learn what is the investor interested in, where can we focus our originations, what kind of data points are they interested in. I mean, specifically with institutions, I was having an interesting conversation just last night, and I said, we've got 500 data points, more than 500 data points, and institution said, great, we'd probably look at 50. Right? But I wouldn't know which 50 if I wasn't collecting the data of what actual 50 they were looking at. So I think it's really important for platforms like us to be collecting data. That being said, it has to be done in a secure fashion. It has to be done in a fashion where you're not abusing that data, but the data is incredibly insightful to us. And I think one of the benefits of us being finance companies first and technology companies second is the fact that you can use that data and you can learn from that data.
Anybody else?
Yeah, I'll echo that sentiment. I think data is huge. I think there's two levels of data. There's investor appetite, what investors want, what geographies they'd like to invest in, whether they want to be in debt or equity investments. So we do collect that data. And the second set of data I think is very important is, we're creating an industry within an industry. It's real estate is the larger industry, and we're creating a crowdfunded real estate industry, similar to what REITs did, right? They took off a tranche of the total equity or debt capital in the markets, and now it's part of the REIT market. So I think the norms, so for example, fees being charged or LTVs that are being standard across the board or certain markets that are achieving certain returns, those data points are very important because they allow investors, as Jillian indicated, to make more informed, transparent decisions regarding where they want to put their money. Someone charging a 2% acquisition fee or someone charging a 0.5%. Someone doing in-house property management above market rates, or someone outsourcing it at market. So those data points we're also collecting, and I think they're the more important ones for us in the near term because they help educate the investors on where to put their money.
Anybody else? Okay. I guess the question for me is, as these platforms begin to expand, more product is on, whether it's debt or equity. Are the Googles of the world going to be able to search your sites and bring everything up to one level so I, as an investor, can go on and do a super site and web crawl and then say I want to have X, Y, and Z, as you said, whether it's management or whether it's a particular social issue or a loan in the UK because I like their accent, whatever it is, I can just go in there and it'll just pull those deals up. Are you working on that technology, looking at that technology? Is everybody kind of expecting that? And what are you doing relative to that issue and challenge?
Presumably it's happening. I mean, it's happening already with the peer-to-peer loans and credit card markets. So we expect it to happen. We'd love to be able to imagine that it evolves to the place where that's happening. So absolutely.
But I heard today that there was a belief that we're a long way away from the kayak type approach. Do you agree or disagree?
We're inclined to agree in the sense that it's still an evolving sector. So certainly we're familiar with the UK, but there's no two platforms are doing it the same way. Is it?
I don't know. There you go. Look at you. You settled down now. Okay.
Yeah, no two platforms are doing anything the same way, so I think it's very difficult to have a comparison. Sort of.
I'll add some to that. So, the regulatory scheme also prohibits, SEO advertising specific offerings. So until there's more of a kind of industry norm in terms of advertising offerings, not advertising offerings, you're not going to see an aggregation tool that's at least worthwhile. But I mean, we have the benefit of dealing with real assets, like I said before, and one of the ways Zillow and Trulia really maximized the amount of searches happening through their platform were through platforms like Google, where you put in 123 Main Street and Zillow and Trulia are the top 2 searches. So the benefit of dealing with a real estate asset is you can put in a physical address and find out, hey, it's being crowdfunded on Realty Shares or LendInvest or Realty Mogul, and you really have an address to look at. So I think it will play a part. It's just a little early, not standardized enough to really make a big impact at this juncture.
Okay. With the time that we have, and as I understand it, we're going to take a break, and then for those of you who are interested, we're going to be answering questions and go into some additional discussion over in another room. We'll figure out what room that is, but they'll tell me afterwards. But can we go starting with you, William, and just kind of go down the line? We've been showing these pictures of deals that have been done by Realty Mogul, by all of you. And so I want to make sure that you can talk about a particular deal, give us an example of a transaction that you're either most proud of or you think represents the high point of your site to date.
Sure, I actually haven't seen what projects are listed up there, but I'll talk about 2 deals. One is a 2-family development in Austin, Texas we did, which we raised $600,000 from 22 people in 21 days for a guy named Brian Hancock from Inter 10 Development. That was a very interesting deal because there's a huge social media component. He is the number 8 top real estate blogger on BiggerPockets. So we really used his influence over social media to get attraction to the asset itself. The other one that's being shown is this one, is the 50-story tower in the financial district in Manhattan. And it's a very difficult deal. It's a 3 to 5 year time frame. What we did was we crowdfunded $7.5 million to purchase the initial piece of land in the assemblage.
Very good, thank you. Jillian.
So by far the most fun transaction we've done is the Hard Rock Hotel in Palm Springs. It's a wonderful asset from real estate. It's right on Palm Desert Canyon, and it's fantastic from a location perspective. In addition to, the excitement around it being the Hard Rock Hotel. But across our platform, we've made 67 investments in the last 12 months. We've been in business just over a year, and we're really striving to be cookie cutter and boring. So I'm going to take a opposite approach, which is, we just want to do good real estate. We want to provide debt on, either good real estate or properly priced real estate from a risk-reward perspective. But some of the transactions that you see from us are ugly, right? They're ugly apartment buildings, they're ugly residential single-family homes, they're ugly hotels. We have no problem financing ugly assets. For us, it's if the loan-to-value makes sense, if the market makes sense, if the sponsor or the borrower makes sense, we're more than happy to do that. And really
we call those C assets. We don't call them ugly. They're
call them ugly.
B, and C assets.
But for us, it's about size and scale while maintaining credit quality. I'm a big believer in growing quickly but conservatively, and quickly because we're all in this P2P space and it's growing astronomically, but conservatively where you want to keep underwriting guidelines tight and you want to make sure that your credit quality maintains to your standards. So I'll go down saying that we fund ugly assets.
C assets. Nav.
I couldn't agree more with Jillian. I mean, not all assets are going to be beautiful and picturesque because we're trying to build scalable marketplaces and we're trying to focus on quality of asset, not just what looks good on paper. And I think that can be a little bit deceiving as well to investors who just look at what an asset looks like on the computer or on a picture rather than what the returns are. With that said, I want to share 2 projects we did that I think were both sound from an investment standpoint, but also had a community benefit. So we've worked with the National Community Stabilization Trust. They're a middleman between bank sellers of foreclosed assets and below market buyers, so affordable housing, basically providers. So we funded 2 of their assets where we worked with a project sponsor who acquired the asset during a first look period, rehabbed it, and then sold it to an end buyer that qualified by having below market income. So that was great because, I mean, they were ugly assets and they weren't anything beautiful, but there was this community component to it.
C assets.
There were C assets, B assets, B minus.
I'm only allowed to fund the ugly ones.
She has a monopoly. But that allowed investors to get a market return, but see past just the return into what are they doing for the community, right? And what's unique is we have investors all over the country. And you have investors in California investing in Florida and Texas because that's where they see yields. But for those specific assets, most of the investment dollars came from a 10 to 15 mile radius of where the assets were located because of that community component. So it was so that obviously shows you it wasn't just about the returns there, it was about the community.
Christian.
Yeah, for us, I mean, our most exciting transaction was probably not exciting because of the specifics of the deal itself. So it was a £4.1 million bridging loan, which was a pretty plain vanilla bridge. For us, it was to a borrower that we'd worked for a number of years, so a long track record with that borrower, but exciting for us from a PR and marketing perspective because we were fortunate enough to be featured on the front page of the Financial Times for the deal, which is awesome for us because the Financial Times is usually quite skeptical about peer-to-peer, and it was a positive story that they wrote. And also a deal for £4.1 million normally wouldn't sort of register on their Richter scale. So it was exciting for us, and yeah, it was a good deal. It'll be more exciting when it gets repaid, but that will be another story, hopefully.
That's right. Tom.
We all agree. We've currently got on this side a $750,000 mezzanine debt piece for a CVS, University of North Carolina administration building in Chapel Hill. So it's with a sponsor that we know well. We have a lot of confidence in them, and so what we hope to do, continue to do, is work with reputable sponsors and work with them primarily in major markets. So we'll stay around the Smile in Chicago.
Nice. I guess finally, where do you each in 30 seconds or less expect your company to be next year as a multiple of where you are today from a business perspective? How busy are you going to be next year, William, versus this year?
We're busy today, and we expect to be busy next year as well. Where do I see ourselves in terms of a multiple, in terms of transaction volume, you mean?
Yeah.
We launched 7 months ago. We've originated roughly 25 million. Our goal next year is to be in the 9-figure number in terms of originations.
Okay. Jillian?
Yeah, I think for us, it's going to be in the hundreds of millions in originations. And again, it's going to depend on credit quality and making sure that we can originate that in a manner that makes sense. It's not strictly about volume. I think that one of the things that Renaud at Lending Club did brilliantly is manage growth. And I think that's a big part of the reason why he was standing giving the keynote today. And that's really, really important to me as the CEO of this company, is to manage growth and manage credit quality.
Nav?
Because there may be venture capitalists in the audience, I won't give exact numbers because you'll hold me accountable to that next year when I'm raising money. But yeah, definitely substantial exponential growth, standardizing, scaling, developing processes that can be automated will play a big part of that. Sourcing, how we're sourcing will be a huge part of that. So I think staying niche is really a part of a growth strategy. So we can automate more of it rather than focusing on 10, 20, 30 different asset types. So I won't say exact numbers, but it will be exponential growth if all goes well.
Jillian, I just have one question for you. How are you capitalized? You were recently capitalized, and who represented your investor?
That was a setup.
Yeah.
We just announced that we raised a $9 million Series A from Canaan Partners. So they've been fantastic partners to the company, and what that means is I'm on a hiring rampage right now. So there should be expected exponential growth at Realty Mogul, and Goodwin Procter was represented, but I paid the bill. So
Exactly.
Thanks, Lou.
Anyway, I cut somebody off. Go ahead, Christian.
Yeah, in terms of deal flow, we've lent 36 million in our first year. I think, you know, from here on it'll be 100 million, so sort of more than double. I think for us, the money is there and that the borrowers are there. It's sort of getting the technology right to make sure the credit quality is maintained and sort of we can sort of originate that deal flow in an effective way.
Very good.
Yeah, I'm the 13th employee at Fundrise, so for about a week and a half, I was next to the dog. So if you go to the website, you'll now see that I'm 2 over from the dog, so we're growing.
Congratulations.
And thank you. And
so how many next year will you be away from the dog?
we're well positioned to grow in a healthy manner, and that's obviously, Lou, why I'm out here in California.
Exactly. Okay. Well, that is our time with the panelists. We will be having this additional discussion in about, well, there's a break now, and then about 15 minutes later. I think it's on the floor below, and we'll get that information for you. Okay?
Thank you. Thanks, Doug.